here coming in?
Oh yeah, it'd probably make more sense if you came up the outside.
Just come in and I'll call you up. Okay. Hey, I got 10 seconds. What's up? Bye.
Who was it? Brad. He was trying to call me. He's like, something's going on. Not working. Not as work as it.
Dad, you gotta move out.
Welcome everyone. Thank you for joining us for this month's State of Freight webinar. My name is Brittany Chisnall with the FreightWaves media team, and I'll be your host for today. I'm happy to be joined today by FreightWaves founder and CEO Craig Fuller and SONAR's head of freight market intelligence, Zach Strickland. Today's conversation will cover the latest insights from SONAR, current market trends, and insights from our experts. Craig and Zach will also be answering your questions live following our discussion. Before we get started, I'd like to cover just a couple of quick items. First, if you have any issues during the webinar, please feel free to reach out to our team via the group chat function in your webinar console. If you have questions that you would like to ask our experts, please enter those through the Q&A box in your console at any point during our conversation today. We will answer as many of those as possible during the live Q&A. We'll also be sending a link to the recording of this webinar tomorrow if you'd like to view it on demand or share it with your colleagues. At this point, I will go ahead and turn it over to Zach to kick off today's discussion. Zach, let's jump right in.
All right, thank you for that, Brittany, and thank you to everybody for tuning into this State of Freight, which is going to prove to be probably one of the more interesting states of freight that we have done, because there is arguably more going on now than I think we might have ever had before, because we have the combination of market dynamics that have been shifting for a few months now, but now we have the added layers of the broker liability ruling that happened. I was literally at a conference when this landed, and everybody in the room was basically caught completely off guard. So we're gonna break that down, but first, Craig, we've got a chart behind us here. You tweeted about this right before the start of the show. This market is so chaotic that we have now returned back to COVID in the terms of spot rates.
I don't think it's chaotic, Zach. I think it's incredibly bullish. I don't think chaos is the right term. There is no chaos. It is absolutely one direction.
One direction.
It is going in that direction, and it is incredibly bullish. I don't think it's chaos. Now, maybe
if you're procuring freight,
compared to where we were a year ago, freight is just chaotic, period.
Yeah.
It has been incredibly volatile over the last couple of years. It might be the most volatile commodity on the planet. Mm-hmm. But what I think is really interesting is there's no chaos happening. It is one direction, and it is going up there. It is the absolute, Harry Styles would be super proud of what's happening here, because it is going up, up, up. And That's what we have to say. We hit a brand new record of $3.69 yesterday, or I should say, the old record was $3.68, and I actually tweeted, will we hit a new record? We're off by 14 cents. Last week, during Roadcheck week, we hit $3.61. So the question was, what do we see follow through this week? And we absolutely got the answer today. Brand new record at $3.69.
Yeah, this is the daily print. So
this is the daily print. This is the daily print. This is not the weekly print. The highest daily print was $3.68. This will drive the weekly print. We're headed in. Anyone who's been around trucking knows that holidays, you do see higher rates going into holiday weekends. You do see higher tender rejections going to holiday weekends. This year's no different. I think the big question we all asked ourselves was during Roadcheck week, would we have a follow-on this week? Would we continue to see tightness this week? And the answer is an absolutely resounding yes. And the question is now, I think this is a lower number for what we'll see all weekend. I think this is going to continue to rally through the weekend. That's going to bring the weekly rate way up. And so I don't see any softness coming into Memorial Day. The question is what happens post Memorial Day? And Zach, I think we're up. I think it's going to continue to rally because June is the busiest month of the year.
For sure, from a shipping perspective.
Shipping perspective.
We traditionally do see a little bit of a downward slope on it after a
very, very, very temporarily. It is very soft. Yeah. Unlike some of the other holidays, right after New Year's, you see a drop. Usually a 2 week after that, you see a pretty significant slump. Yeah. You saw this after Easter, things kind of cooled off. I think Memorial Day, let's remember what happens in the month of June. You've got a combination of beverages, shipping, and beverages are directly related to weather. You've got the big construction season. You've got gardening season. You have a lot of the summer goods and summer activities that take place. You start to also see throughout the course of June and July a little bit of positioning for back to school. Yeah. Back to school is a lot earlier than it used to be. For a lot of kids, they're going back as early as early August around the country. And so these big tax day savings, these tax holidays do drive that part of the season. And so there's no reason to think that we won't have a real bullish June. It's always June, even in soft years. Yeah. Where we've looked back in the Great Recession, we did see throughout the summer is that June was incredibly strong, even in softer years. So there's no reason to think that that won't be the case this year.
Yeah, so I did a recent SITREP report, and I actually saw that one of the fun facts that I learned is that actually June is almost like the perfect month where all industries are shipping.
Interesting. So not a massive overlap. Why is
it basically a giant overlap? So you got manufacturing, which tends to take the winter off, is shipping heavily. You've got retail that's starting to ramp into its peak season later in the year, but it's shipping. And you've got all these other sectors.
Well, I think it's interesting. Construction, regardless of, housing is not super robust. Some would say it's really soft, but you do have housing and it peaks in summer. Auto is a huge driver because they're building their brand new cars. That what they do is they retool in July, but they bring a lot of the sort of last push out. And so that also drives some of that summer peakness. And so to your point, Zach, I think June is a month we're going to see stronger conditions. There's no reason to think that it won't be stronger. I want to make one statement here because I want to be very clear. STVI, which we've been talking about, is our SONAR truckload volume index. There's a data error in that. So if you're a SONAR user and you look at it and say the last couple of days it felt really weird, that's absolutely right. That is a data anomaly. So we're recommending for at least until this gets fixed. We think we know the problem. We've identified the issue. It's a data feed issue specifically. Just some data reports that didn't get in there and somehow it didn't get caught. We'll fix that going forward. But OTVI is the index you should look at, and it's actually doing quite well right now. So outbound tender volume index, if you look at it and look at the year-over-year print, look at where we were a year ago. This was Liberation Day tariffs, and Easter was there. We saw a little bit of Easter softness, but really, we've started to really, I guess that's early May, we started to really surge. That's Easter. We started to really surge after a little bit of catching our breath in May, and now we're above 2024 levels. 2024 was actually a really good year in volume. An abysmal year because of the oversupplied nature. But look where we're at. We're about to end. I mean, look at the peak that we saw the last couple of years happened in June, and it's setting itself up just like that this year.
Yeah, I think, for the most part, I think everybody would largely agree with the fact that this has been a very supply-centric kind of contraction.
Well, we've had a contraction of capacity. No one's going to dispute that.
We've had volumes higher and rejection rates lower in the
Yep,
past. Like
that's right.
2024 was actually, this right here was actually extremely strong in terms of overall demand. We
The
just still had too many trucks.
Volume was absolutely strong,
Yeah.
but we were still dealing with a lot of the oversupplied situation, which is now very clear. It's interesting. If we look at back where we were, say, 2 years ago, it wasn't clear, at least to us and I think others, just what was happening with the capacity map. We didn't realize that immigration was so pervasive and how much expansion was being caused through a lot of new entrants in the market. Now, I know I'm gonna get hate for that because, like, we told you so. Yes, you did on X, my friends on X, you did point it out, but it was hard to see it in the data.
Yeah.
And it was hard to understand it. And, you know, we have a tendency to look at the data and try to draw conclusions in real time. That's what we do. And it was just hard until we now know that this was a largely oversupplied situation caused by immigrants. We had multiple conversations, Zach, of like, what is keeping these trucks alive? Like, how are they staying in business? It's very clear now that this was a labor availability, an immigration-related availability that really kept a lot of new entrants, created a lot of new entrants into the market that oversupplied it. And then what we've seen over the last year is the administration has come in hard and fast. They're putting a lot of restrictions on non-domiciled CDLs. They're starting to put more restrictions on the CDL mills, which is cutting off some of the supply. You've got just immigration, period, in the United States. It's actually cutting off new drivers or would-be drivers. And then you have the risks of, if you're a driver that perhaps doesn't have, you know, that you're worried about getting picked up by immigration, by ICE, you don't want to be on the roads anyways. And so we're seeing a lot of that happen. At the same time, you're seeing a lot of the fact that motor carriers did not add equipment for many years and expand their fleets. And normally what you see is in a down cycle, as you start to come out of that, the bigger fleets start to expand their trucks. They didn't do that. And they weren't prepared to do that because they just like, I don't believe it.
Right.
Now, I do think we will start seeing, and you're hearing this in the OEM reports of the Class 8 trucks, we are seeing some expansion. But I don't think it's going to be enough to matter. I mean, this is definitely a market on fire. And the one thing that hasn't been a factor for the last couple of years has been the industrials. Now, the consumer side of freight is actually not doing great. CPG volumes are down.
It's hanging on.
I think Walmart had a report talking about some of the consumer weakness that they're starting to see.
They're concerned about the second half of the year for sure.
Yeah, but so it's interesting. There is some concern about consumer activity, but absolutely in industrial and factories and AI data centers and defense and energy, those things are absolutely doing great. And that is going to keep part of the market alive, where maybe if the consumer rolls over, if we didn't have the industrials, we'd have a lot.
Well, ultimately, everything ends up in a consumer. I mean, we manufacture for the consumer.
Consumers spend their money, but also what we have now is this $800 billion of capital spending coming into the economy through AI data center construction that has not been a factor. I mean, if you think about the largest, we've talked about this, the largest infrastructure investment in history was the interstate highway system. That was $700 billion. This is $800 billion in a year. That was $700 billion over 35 years. You're talking about just $20 billion a year. We're doing that every 2 weeks. And so I think that is a factor. It's a lot bigger of a factor than I think a lot of people may want or may understand. You also have the defense spending. The new defense bill is up $500 billion is the proposed defense bill. Again, that has to get through Congress. That's next year, but 80% of that is in procurement. It's not going to troops necessarily. Some of it is, but 80% is going into new weapons to refinish the stock. So there's a lot of reasons to be bullish on the industrial side of the economy, and that's going to really help a lot of the freight market.
So, but in the meantime, while we're focusing on this big bump, like right now, how are you feeling about the demand situation for the next, say, two to 3 months?
I feel good about it because I think the industrial side of the economy, who was not participating for the last 3 years, despite this was really consumer.
Yeah.
Despite the peak that we had in 24, that was largely consumer-based, industrials were not participating. And so now they're going to participate in the freight market, and I think they'll drive a lot of it out. I mean, at the end of the day, it's the interesting thing when we talk about consumer pullback. We've talked about this before. Is consumers will downshift their spending in cheaper categories or cheaper products. So there's the story about Costco. People are not buying steak anymore. Now they're buying chicken. Right. They're buying cheaper forms of meat. And so I'm sorry?
Cheaper replacement.
cheaper replacement. And so what is happening right now is we're getting a lot of warning signs about consumer slowdown using cheaper replacements, but the volume tends to stay persistent.
Right.
And so I don't think it really matters much in terms of volume of freight volume, but I think we have this massive stimulus coming in from the industrial sector, which has not been participating for many years, is going to drive us through the rest of the year on the demand side. So I'm not overly worried about it. In fact, we're not seeing any real weakness on the demand side. In fact, you would argue that this year is much better than last year. And even when you look at things like flatbed and railroads are strong. And the one thing also is that our industrial competitiveness due to our massive energy supplies here in the United States and abundance, and I'm particularly talking about natural gas, not oil, even though we have that, is actually really important for our industrial competitiveness globally. And I think that will carry us through.
What do you think about the employment figures, though, on the industrial side? They've been largely negative over the last.
That's a lagging indicator. It's a lagging indicator. So employment is a lagging indicator, because what happens is if you're building a factory, or you're running a factory, let's say, if you're running a factory, you'll extend shifts, you'll stretch your employees out, you'll try to find productivity, you'll use automation as much as possible. I mean, a lot of what we're driving, is driving the industrial sector right now is stuff that isn't traditional manufacturing employment. So textiles, which used to have, people making shoes or shirts or whatever, or carpets, huge factory floors of thousands of people. That isn't the way the modern manufacturing economy works. And you're looking at much more automated factories. Energy is a much more important input than labor than it ever has been, because these factories are automated. They are largely more productive. Productivity is up. Employment is a lagging indicator. And I think that's why when we think about employment as an employer, the last thing you want to do, and I think manufacturers after the last couple of years, the last thing they want to do is get ahead by hiring people. And we're hearing a lot where they're extending shifts, they're adding shifts, they're asking people to work overtime, they're getting paid. By the way, we haven't even talked about the fact that overtime is tax-free.
Right.
Think about how big of an impact that has in human psychology. Like, if you are working at a factory where in the old days you were asked to work overtime, you might like the time and a half, but guess what now? That money matters. And I think that's one of the reasons, as we have more productivity in the factories, is that lagging's not going to come as fast. And frankly, we don't have as much of employment. I mean, one of the byproducts of this crackdown on immigration is you don't have an enormous amount of people to go hire.
The participation rate's been dropping every month. Yeah,
that's right. I mean, people are getting older. We don't have a lot of new people coming into the economy. There are concerns. If you look at some of the stuff from the Fed that's come out in the Blue Book, they will actually come out and talk about the fact that
demographics.
The Beige Book,
We have like
the Fed book.
I think there's something like this is the largest amount of 18-year-olds we'll ever have.
But a lot of those 18-year-olds are, a lot of the younger people are college educated.
Right.
College educated can't find jobs.
Right.
That's the problem, is the jobs, these entry-level jobs, companies are not hiring college educated young people. They're not 18, but they're 22. And there's a tightness of people that will work blue-collar jobs, the old crafts jobs, or the trades jobs. Those are actually in high demand, and you can look at it: electricians, home builders, carpenters, HVAC people. All of that stuff is in super high demand, and data centers are pulling that. If you talk to people that are in construction, home construction, they'll tell you one of the big challenges is labor availability. They can't get people that, not only and they're not taking out building homes, but one of the reasons they're not building homes is because they can't get access to labor because of the lack of immigration. And so the labor they do get is going into build data centers and other types of big projects, building pipelines, things like that.
Well, of course, the data center build out is going to be huge, and it largely impacts flatbed right now. I want to get away from the demand side components.
Real quick, you comment about a sit rep. Let's talk about what a sit rep is for those that aren't familiar with a sit rep.
Yeah, go to the data center sit rep, and that's a good one to talk about. Also, we have the recent broker liability sit rep.
So if we go up, can you zoom out real quick, Will? So a sit rep is basically a set of research, a situational report. And effectively, what we are doing here is assimilating all of this data. So we get asked questions every day. we look at the team, we're getting asked 10, 15, 20 questions a day from shippers, carriers, brokers, people on Wall Street, random people in the audience, or random people on social media. What is going on with this topic? And so we assimilate all these questions, and then we try to go answer them using our own data, but also broader data sets. And so we now have this is a white paper. It's a long form research topic that you would see with a big, typically I like to use the McKinsey style research report. And effectively, we're trying to answer questions that everyone's asking. This one that just came out is the impact. Zach, you may want to, your head's in the way. This is a SCOTUS broker liability thing. And what's nice about that is we're diving into what is the impact of the SCOTUS decision, 9-0, and what does this have? We have another one that's the earnings blue book, where we went through and took all the transportation-related public companies, 71 by the way, and looked at how they were thinking about it. I did this one. What was interesting about it was, by the way, I had AI rank taking the transcripts from the conference calls and ranking them on a scale of 1 to 10. It's its own ranking, and I didn't put any bias to it. I was like, on a scale of 1 to 10, tell me how bullish it was. What was interesting was it came up with its own version of it. It came up with its own answers. Is that the industrial real estates were actually had the highest aggregate score of all of them. This is your Prologuses.
Yeah.
Makes sense. If you're seeing reindustrialization, and I'm close to the Prologis folks, and they have said they're seeing the Midwest, the old Rust Belt, that's where the activity is. They're very bullish. They're the most bullish group. Poor Wabash, the only trailer manufacturer that's public. Poor Wabash, not a good thing. 3.75. I want to talk a little bit about the equipment in a second.
Yeah.
Go ahead.
That was going to be my question, is why do you think this one right here was so negative?
The perfect person to answer this question is an old school trucker that I know very well, and many of you know very well. I want to bring Max Fuller, my father, on, who probably knows more about equipment purchasing and procurement than anybody else in the industry. Dad, you have bought hundreds of thousands of trailers. I think one of the craziest stats was that I think you bought 100,000 Freightliners is the number, if I'm not mistaken. The craziest stat was if you took the number of trucks, lined them up, you would go to the moon. Like you could stack them up to the moon.
Probably.
But trailers, you bought as many trailers, if not more, than you did trucks.
It's usually about 4 times as many.
So let's talk a little bit about why is Wabash so bearish?
Well, I think there's been two or three different things in the cycle. You got to look at the last 4 years being a down cycle, and then you got to look at the fact that before that cycle, a lot of carriers were buying extra trailers, like J.B. Hunt, to put into the brokerage operations, so other carriers could actually haul their trailers. Some of those companies that bought those excess trailers, it didn't work. So now they've actually had to find other homes or not buy new trailers.
So power only is a big piece of that.
Yes.
It's the Box 360. Convoy bought a bunch of trailers that actually, talking to people that were close to it, was one of the many reasons Convoy went under, was just the trailer was a burden for them. The thing that is interesting about this is a lot of the administration's crackdown on immigration are really small fleets. They have trailers. Do you think that getting rid of small fleet operators means that you're going to have more trailers in the market, the used market, or is the typical trailer that's being bought such that it's not being bought by these operators? What is your read on that?
Typically, your smaller operators have used trailers. The problem is a trailer can stay in the market for 15 to 20 years. And especially when you get into like the Wabash Duraplates, those trailers, there's actually some that I bought 20 years ago. They're still running and still look good. So that's part of the problem too, is they stay there. But small carriers typically buy used equipment. That used equipment sometimes goes away relatively fast, especially on the tractor side, but not necessarily on the trailer side.
So let's talk a little bit about, trailer, Wabash, again, 1 for 1, because it's the only public trailer company that is here, got a very low bearish score. I think they had a debt downgrade as well related to it. Probably put them in a really bad mood when they did their conference call. Getting your debt downgraded is never a good thing. I want to talk about the truck manufacturers, because you know a lot about buying trucks. The question is, you have a new emission standard coming out next year, but you also have a question of, so is there a pre-buy going on? But also, with the market doing what it is, if you were back at U.S. Xpress, how would you be thinking about expanding your fleet right now?
I'd be trying to hire every driver I could going into the environment that you were just talking about. You know, we've gone through 4 years of down. You're probably going to go through at least 4 years of an upcycle with probably premium rates that we've never seen before, you know, because you've got more things going on. Truck safety is going to get a lot better with what's going on, especially with the brokerage regulations that just came out.
The SCOTUS decision.
SCOTUS.
Yeah.
That's going to help a lot. But then you've also got more equity being built by carriers. You know, they used a lot of equity during the last 4 years. Now they're starting to build, just really in the last few months, starting to build that equity base. That's when they start buying trucks. That's also when they start hiring drivers.
So here's a question.
So if at U.S. Xpress, I'd be trying to hire every driver I could right now going into the environment that we're going into.
So the question I think on everyone's mind is, how do we avoid oversupply? So if that's true, if every other fleet executive in Phoenix, Arizona, and Lowell, Arkansas, and New Jersey are thinking the same things that you would be thinking, how do we avoid a bust cycle that is inevitably at some point going to happen?
Well, I went through 55 years in this industry, and it just keeps repeating itself. This cycle will probably be much tougher because of demographics. You don't have the number of people out there that are going to be looking at being a truck driver nearly at the level that you did, say, 20 years ago.
And immigration's not. Immigration's a lot. The restrictions on immigrants are just one factor to it, but also the crackdown on regulations, the improved regulations, the regulatory crackdown, the fact that brokers have been really, yesterday we had our fraud summit in Cleveland, Ohio. Kevin Nolan has built under management, $7 billion in freight under management. And we got up there and had the conversation, and he's like, talking about the increase of drivers and the increased capacity. And he said, it's not the government's fault, because it was a previous speaker that had made that comment. He goes, it's not the government's fault, it's our fault, talking about the brokers. His point was, brokers had been where small carriers have thrived. And now, and they haven't had to do the same underwriting on safety. They had to underwrite service. Obviously, price is important to them. But in safety, they never had to make that calculation. What is your view on what will happen with SCOTUS now that the broker potentially is held liable?
Well, I think the brokers are going to have a lot more issues than they had in the past. Obviously, they've got to vet out the carriers. The large carriers typically shy away from brokerage unless they're doing brokerage themselves. I think they're going to have a tougher time going forward to find the capacity that they really need to be operating with.
Yeah, my understanding, and it's been dated since I was at U.S. Xpress, but I remember the old days we had 3 or 4, you had the 3PLs, the managed trans folks. In these days it was like Transplace and the old Menlo Logistics, which is now, I think Menlo ended up maybe at RXO. But you had all of the old managed trans companies. You guys were always comfortable hauling managed trans business because that was sort of an outsourced shipper. Traditional broker, you had 3 or 4, and maybe you got into Montana and there was like one dude up there that ran the state, but that's it. You weren't taking freight from hundreds of brokers.
Well, mostly what we did at U.S. Xpress was go to people like C.H. Robinson.
Because they had so much freight.
They had
make
so
it
much
single
freight.
You'd always get paid.
We always got paid. We always took their premium freight. We usually didn't take the cheaper freight unless we really had a situation in a certain market. So we were highly selective. Brokers do provide a good service to the industry, and it helps fill those gaps where maybe a carrier doesn't have a backhaul. So that's the gap that they fill. But at the same time, I think they got somewhat out of hand on the type of carriers and the type of business that they were trying to create.
Somebody kept these non-domiciled, conditional, and unregulated carriers in business. And it was, I think that's a fair statement, because that is what's been, a lot of the small carriers that have sort of been off the radar have been able to do that because brokers have been supplying them freight. That wasn't the way it was 20 years ago.
Right. Well, the frustrating part being a large carrier, you see someone go in and you cut the rate by 15 to 20 cents a mile, you know they're not doing the same safety, same driver amenities, same type of service for the customer. I mean, it's a lot of years apart, but yet they got freight.
Yeah, they got freight. That's
They got
important for
freight
small
because they were
operators.
cheap.
Small operators. Let's bring Zach in here back. I got to ask Zach. Max has given us some perspective on capacity. You can stay here, Max. We're not done with you. We got lots more questions here because your history in this business is very important. Because I think historical
For your
perspective.
dad, real quick.
Go ahead, Zach.
Because I really got to jump in and ask about, so Wabash, so we've got, you said you would recruit and just go haywire trying to get some drivers, and it's a challenging market to recruit, and equipment takes 9 to 12 months to get those orders delivered. Would you not think that would kind of boost the trailer pool a little bit for drop trailers?
Trailers are a lag though.
Okay.
Usually you buy new equipment, buy new tractors, then you buy the trailers.
Right.
Usually they can be produced a lot faster
Right.
than a tractor. One thing we would do at US Express when we're expanding is we'd go order tractors, and it may take 12 months to get it. But at the same time, I'd have trades that I wouldn't turn in. I'd delay turning those trades in so I could grow. And if I was wrong when those new trucks come in, I just flush the trades. So that's
Not
part of the
trades
business.
being trucks, not trailers. Okay, got it.
And it kind of worked the same way with trailers.
The trailers have a much longer. What is
The
a
long
typical
life-
trailer? From the time that you guys bought it, the time that you would get rid of it or turn it in, how long was the typical cycle?
Well, at US Express, we ran them for 10 years, but those trailers were worth probably a good 15 to 20 years. I owned a trailer rental company called Paragon Rental. We actually bought Wabash door plates like in 1997. I still see some of those trailers in the
Yeah,
marketplace.
I see them around town.
Yeah,
I mean, I've seen them on the
they're
highway.
that old.
Yeah, there's every now and then, so for those of the audience that may not be familiar with it, there's a company called Southwest Motor Freight, which your father used to own. You worked there for a bit. You first bought it, I think, 1990?
Right.
I occasionally, now, it's interesting because they're stripped, but I'll see the Southwest Motor Freight logo in the background. It happens, it's like looking at it's a Yeti sign. You kind of like rarely see it in the wild, but you do see them. It just shows how old these. I mean, you can still see cornflake trailers driving around. You can still see some old school truck trailers that are still there. A lot of them have been turned into storage if they're out there. But on occasion, you're like, man, that thing is like lived more lives.
I mean, if you take care of those trailers, they'll last.
Well, one thing we used to do is try to inspect long life components, so we could run them 20 years if we needed to. But then, the value at 10 years is high enough to where we'd trade them in, buy new trailers. So
I mean, look, I think this makes complete sense. Prologis is bullish because of a lot of the industrial activities, data centers. If you're going to build a factory, you're going to build a data center, you got to store a lot of the equipment.
Tons of stuff. The sit rep on data centers is insane.
It's 7% of flatbed. It's 30,000 truckloads just connected to a 500 megawatt data center. By the way, Zach.
Also the power grids.
Oh, the transmission lines, the copper. You got to have piping.
Yeah.
Just the cooling units. Like the whole the amount of concrete going into these things. Because you read the headline, you're like, oh, these data centers is going to be all chips, like GPUs. Right. That is only a very small piece. Not necessarily the dollars pumped into it, but the small piece of the overall construction of the project. It just takes a lot of concrete and steel and piping and cooling systems and all sorts of stuff.
Yeah, and I think one of the interesting things, Will, if we scroll down to the bottom here, down here at the very bottom of the sit rep is actually what I find one of the more interesting tidbits is van and reefer undercounted right now because a lot of that stuff's going to come later.
Yeah, that's the latter piece of it. You have the batteries, you have the cooling units, and the thing that I also get asked a lot is this assumption that this is all going to go away. It's a flash in the pan. That is not what we see at all. In fact, 8% of data centers that have been contracted are currently in even level construction. And even when you say some data centers got put on hold or canceled due to lack of power, which is the primary reason the data centers are being canceled. There have been some ordinances where some states and cities have said no more data centers.
Right.
Those are getting caught up in some political issues. But there's a long lead cycle of data centers. There's no doubt that this is going to continue.
Yeah.
And you look at like Anthropic's ARR went from something like $1 billion last January. I think the number is like $45 billion, the fastest growing company in history. That's an AI related play. You look at all of the other companies, NVIDIA is not slowing down whatsoever, and they're talking about how bullish they are.
Right. We need to talk about tender rejections.
Oh man, let's talk about tender rejections.
We haven't talked about tender rejections once, and we're coming up on time. But
Reject my tender.
so Max, I got to ask you this question because I've heard Craig's take on it a lot over the last several years. Tender rejections. Can you explain like how a carrier, like when they reject freight, like mentally, like what is that?
This whole thing came from what I used to use
Right.
at U.S. Express to gauge our business.
Right.
And I could look at our business and say, okay, we've got certain customers that, we guarantee service. We've got other customers that are somewhat discretionary. Those customers, basically, if I had an alternative rate with somebody else that was higher, I'd take the other guy, the higher rate guy. Okay, so I'd sit there and I would measure the up and down, so I kind of know what was going on in different markets.
Right.
That would tell you when you need to raise rates. It also tell you when you need to get ready to lower rates too.
Right.
And rates follow a cycle.
Zach, when I would ask my dad, if you ask a trucker and a lot of people in trucking, how's business? They always quote rate.
Right.
Rates are going through the roof. Right. You ask a big carrier, and I bet if you walk into J.B. Hunt or you talk to Knight and Swift and Covenant and U.S. Express and Werner, and you ask the CEOs how's business, they don't actually lead with rate. You know what they lead with? Turndowns, rejections. They actually talk about rejections. When I used to ask Dad how business, he would say, we had 2,000 turndowns today. What did that mean? They rejected 2,000 loads that they were offered. The rejection rate is a percentage of the overall orders in offer for the whole market.
Right.
We're at cycle highs of 16.29. Yep. And what is really interesting is RXO, number 3 broker, I think, in the country, came out with their update. They do one, I think, halfway through each quarter.
Yep.
And their stock ripped, by the way. And what was interesting about it was they talked about how bullish they are. Rates are up strongly. Market activity is up strongly. And they have been the biggest proponent. Drew, the CEO, constantly talks about how good the spot market opportunities, which drive so much more margin for brokers and for his business particularly, when rejection rates are high. And so what that tells us is as rejection rates go up, more spot opportunities go up, and that's what's driving the market right now.
Yeah, and of course, utilization is the priority in the large.
In theory, utilization is what you got to manage.
Right.
And then rate should be more.
Comes after that.
That's why contract rates don't move. That's why they're a little bit more static.
Customers are going to move the rate on you anyway. Right. So you manage your utilization.
Right.
But then, if you really look at what's going on right now, with the rates being as high as they are.
Rejection rate, 16.29.
You've got a cycle here that's really starting to get very, very solid. What usually follows high industrial production is high consumer.
Right.
You're talking about consumer being off. He's going to arrive somewhere down the line.
I think the employment factor is a factor.
And this AI stuff is not going to stop. The data centers are going to keep being built.
Right.
So you're going to have kind of double upside.
So
that's the reason I say this is going to be a long-term cycle. Shippers have got to get used to it. Yes, they've got to have good rates, but at the same time, they've got to find carriers who are going to give them good service and find good, safe carriers.
Yeah, I think safety is a big thing. I get your take, Dad, on SCOTUS. So arguably the biggest event to happen in trucking
since deregulation.
Since deregulation, and probably in Supreme Court, the biggest decision in history, as far as I can tell. Massive shift of liability or opening up of liability to freight brokers. What is your readout on that from just what you know of what's happening?
Well, from what I see, they're progressing to the point where the shipper is going to have liability, kind of like the brokers. This is kind of a first step in a long cycle. And truthfully, shippers sometimes will use a cheaper carrier to get a cheaper rate.
Yeah, and that's always hard, right?
That's, so they support those people that aren't being as safe as they should.
This is the time when partnership, the shippers say, we're partners. And you're like, dog, where were you 2 years ago? If you were my partner, where were you when I needed to move my truck? It's always one of the things that happens.
Well, they always come up with being partners when it gets into a tough market.
Of course, we're partners. You owe it to me. I remember there was a large hardware company, and we used to do a lot of hurricane freight. And I got called into a meeting. It was a U.S. Express. I got called into a meeting with the head of logistics of this very big box hardware company. And the head of logistics was very upset that we were charging deadhead and moving position trucks in. We should do a public service. And I look at him like, are you giving away your plywood? Like, I get it. Like, we have an obligation. But at the end of the day, we're here to make profit. You're making a profit. They were trying to shift the burden onto us, which was unfair. And a lot of times, I heard yesterday at our Fry conference, we had a couple of very large brokers in the room. And we actually had some shippers in the room as well. And I asked the question, what is the post? We've had a week to think about it. What are you hearing? What are you seeing right now? And what was consistent was the shippers are asking questions. Zach, I don't know if you're getting this, but what I am hearing is that there was a very large beverage shipper that said they wanted to see financials of their providers. That they reached out and said, we want updated financials. We want to underwrite you because now, if you are going to indemnify me, I want to know that you have the insurance and the balance sheet to support it. That is a whole new development as far as I can see.
No, I mean, I've heard that in the past before, but I haven't heard as much about any transition. I was at a conference last week. Shippers, carriers, brokers were there. The shippers were concerned in the sense that they knew they were next because this opens the door wide to shipper liability on hiring carriers. The brokers, of course, were the most influenced.
Some plaintiff's attorney is going to take this Supreme Court decision and try to argue in front of a jury that shippers are doing the same thing that brokers do and have the same set of information that brokers do. And therefore, they could potentially have liable. That is a momentous change.
Yeah.
Well, that would play into the large carriers that basically focus on safety, and that would make a big difference in the market.
By the way, I don't know if you guys,
rates up though.
I don't know if you guys have seen the stock market of the publicly traded trucking.
It's great.
Asset carriers. I know you're for it. Look, I'm all for improvement. The brokers too. By the way, of all the major public traded transportation, trucking related transportation names, do you know what the number one, I tweeted this earlier for those that are playing at home, is the number one stock in the last week? Do you know what it is, Zach?
Knight-Swift?
RXO.
RXO? Okay.
RXO is up 19%. Now, a lot of that is related to their press release of the market update. Probably of the brokers, the most exposed to the market cycle. Sage Robinson is up, I think, as of yesterday or this morning was up 11%. Knight-Swift on the news rallied by, I think, the day of, something like 9% or 10%.
All good.
I mean, it strikes me that the large asset guys are the most levered to this market in terms of opportunity. One of the things that I think is misunderstood is rate is only part of the game when it comes to operating leverage of a trucking company. Rate just, that is one factor. You mentioned it earlier. What is that, Max? Utilization, right?
Utilization is the number one key.
Yeah, so that is, I mean, that is the whole thing. So it is all about that, right?
Yeah, and I think the one thing, in the near term, as people are starting to digest the broker liability and what that means, obviously brokerages will change or have to reform their vetting processes. I think what we're going to see first is this reduction of capacity, like continued reduction of capacity, because anybody with a questionable safety record or no history, the barrier to entry here is the thing that nobody's really mentioning, is that now if you don't have any history.
Well, here's the crazy stat. Here's the crazy stat. Now, the FMCSA gets a little defensive, as I learned yesterday as I was interviewing the, I would say defense is the right term. They don't necessarily love the characterization of them not, so here's the data. 1.2 million carriers have zero safety rating.
Right.
They're like, look, we're still doing our job there. It's just our job is not to give someone a safety rating. You effectively have to earn it. And our job is basically to not focus on whether you're safe, it's to focus on whether you're unsafe. We're a regulator. Our job is to focus on the bad actors.
Right.
We're assuming that everyone is, this is the way the Constitution works, you're assuming that you're doing the things you need to do, and you have due process if you don't. And that was a great point, because I think it's important. But there are 1.2 million trucking companies today, or 1.2 million trucks, that have no safety rating whatsoever.
Right.
And here's the problem in front of a judge and jury. How do you, as a broker or a shipper, demonstrate that you did your job to verify that that truck is safe?
Reasonable care.
Okay, but what does that mean? We're going to find out. Plaintiffs' attorneys are going to shape that story the way they want to think. The other side of it is there's 300,000 trucks currently that are in conditional safety ratings, which is a flag by the Federal Motor Carrier Safety Administration that something is not in compliance. That is a much harder case to make if you give a load to a trucking company with a conditional safety rating. That could come back to bite you.
Well, if you ever get a conditional rating, it's hard to get out of that box.
And I've learned this on X. As a driver who I've become friends with on X, he runs a small fleet, and he's like, we have a conditional safety rating for an hours of service issue that they had. I think it was like one issue. He's like, we're trying to get out of it. And he's like, I can't get the FMCSA to respond. And the reality is that these changes are happening so fast and so furious that the FMCSA is an underfunded agency, and they don't have the resources to be able to respond to all of this stuff. We went through decades of negligence of administrations and regulators that were not doing the job they should have done. And now this administration and this regulator is having to clean it all up. It is really a really challenging job. I commend them because they seem to be doing a much better job than any other DOT and FMCSA has ever done, but their work is cut out for them.
In 55 years, this is the best group I've seen as far as being true regulators.
By the way,
They're focused on safety.
By the way, if anyone is interested, we have a podcast called Freight Expectations. Matt Leffler and I jive on freight issues every single week. Tomorrow, Derek Bars, the FMCS administrator, will be here in studio, and we'll be able to ask him questions. And if you're out there, please send us the questions that you would like to ask Derek Bars. We will ask them, but we have the chance to ask the administrator all of the questions that you want to know. Tell us what those are, and we're happy to take some of those, and we will ask Derek himself.
Man, so do we want to go to Q&A now?
I think Q&A is
we got
great. 13 minutes.
Yeah, we got 13 minutes.
Cool. Like he said, we will begin taking some questions from the audience. So if you haven't already submitted those questions, you can go ahead and type those into the Q&A section of your webinar console. We do have a few that have already come in. I'll start with this one. It's interesting with the June forecast because as a freight handler, we have been having a bit of a snooze fest. What does this mean for LTLs like us? Does the pickup in June signify the possibility of acquiring newer accounts?
Our resident LTL expert, Zach.
Yeah, I mean, LTL being the qualifying term here, not as exposed to some of these freight cycles. Now, I can't speak to your specific business, but I have talked to a few LTL providers out there. They are getting what I would call, and it's been reflected in our data too, larger shipments, not necessarily more shipments, but larger shipments are coming through, and they're starting to see some of these rates percolate a little bit.
So when you have a recovery, and this is one of the things in the cash shipment index, which is always sort of, that has more exposure to LTL in terms of like the actual bill counts. The bill counts are actually down in CAS's data. But it's because the shipment sizes are larger. So in the front end of an industrial recovery, LTL actually loses some of its volume to its truckload brethren. It's only when we start to see truckload really get tight and the economy boost.
LTL also is a guaranteed capacity. So as the truckload capacity withers, they start to chop up some of their shipments, and even though they know they're getting a premium, they got to get it off their dock.
With more and more rejections, we will see that increase. Zach, do you think LTL, are you bullish on LTL?
I'm bullish on LTL. LTL always follows truckload, so it will.
We have a brand new LTL index, LTL.USA. You can actually see how LTL rates, national rates have been trending. You can keep an eye on it because it's an important part of it.
There you
see that it's absolutely ripping. Volumes may not be great, pricing's pretty good.
LTL is more consistent.
Yeah.
More
I mean, it has a
consistent
much
than
tighter
truckload.
network.
Yes.
Yeah.
Cool. We can move on to the next one. What advice would you give owner-operators trying to stay profitable while managing rising insurance and operating costs?
I think the best person to answer this question is the only person who's ever ran trucks, Max Buller.
Yeah, I really think the number one thing for any trucker today is to really focus on cash flows, because that's what keeps you in business or puts you out of business. You got to look at costs, you got to look at the revenue, you got to look at utilization. And it's basically a numbers game that will make you successful or not successful.
So what do you say about insurance, Dad? Like when it comes to dealing with insurance, you bought a lot of insurance in your day. What is it that advice would you give an owner-operator in terms of mitigating insurance expense?
Well, he's got to look at his deductibles. If you buy a cheap deductible, then you're going to pay a lot more for it. And what we used to do at U.S. Express is we would buy base insurance and then go to a high deductible.
What would the deductible be on a claim?
Well, it depends on what your policy looks like. You can take a $20,000 deductible or a $300,000.
I think for a small owner-operator, obviously, the deductibles could be deadly because $20,000 puts you out of work. That may not work as well for a small owner-operator as it will a fleet, which is really the issue. But that is one way to control it.
That's a way to control the cost. The way the insurance companies look at it, you're going to pay that anyway. And if you want to be able to level that out to a monthly cost, then go to the lower deductible. If you want to take the risk and hopefully you don't have that accident, then take the higher deductible.
By the way, I think one of the other most important things is shop around.
Yeah.
Get multiple quotes. I think one of the things, yesterday we had a person that owns an insurance brokerage. We had a couple of, obviously fraud is a conversation for brokers. And one of the things they told me, which I found incredibly interesting, brokers don't typically shop for insurance. It's only 1% of their gross bookings, typically, 0.5% to 2% sort of the range. It's 1% for their bookings. So they're not spending a lot of time quoting. The whole thing is if you have truckers, they quote every single year because it's 5% of their revenue. And it's a significant piece of it. So you quote, get as many quotes as possible, knowing that you're getting the best deal. The best way to know it is to call it. And maybe the insurance company that has you, that you've been working with for some time, may not be the right carrier for you. You might want to shop around. Of course, some great insurance companies out there that you should call. And
30 years ago it was about 1% of our cost. Today it's more like 5 to 7%.
Yeah, it's an astounding number. One of the things that is talked about this broker liability is the TIA, the trade association that represents the brokers, Chris Burrows, and I still quote, I had to ask John Kingston, did he say this, is that brokerage insurance could go up 5x.
I believe it.
This is from the TIA. TD Cowen, a big firm on Wall Street, said that truck insurance is 10 times the cost of a broker insurance, and they believe over the next couple of years it'll be parity between the two. Arguably, you could make the case that giving a load to an asset-based carrier might be a safer decision because you at least know who your drivers are. Problem with the broker, I don't know that that's the case. And so if shippers get liability, it is really challenging.
Yeah, and I think too, the thing to think about those, pull up the spot spread, Will, like the spot and VCRPM and NTIL12. Because I think one of the things that this is going to do, because the brokers have not had to carry insurance forever,
right.
And that $75,000 surety bond is really not for liability, it's for
look at this.
payments.
So this is spot, that's contract, it's not moving.
Yeah.
I actually think the dashboard represents it easier today because you can see the divergence. But
I just wanted to say that
the
spread right here, this was a huge spread historically.
Yep.
And this is broker negotiated low end rates.
These are buy rates.
Yeah, buy rates.
This is contract rates. Really what was happening is brokers made a lot of money in that period. Right here, contracts.
Come up naturally. I think the floor of the market is going to have to raise.
Contract rates would come up. I mean, spot rates are already higher.
But I think we'll never see a spread of I think this was like 35%.
This was an oversupplied market that was built by an a market with zero barriers to entry.
Yes.
And I don't see a position. It's interesting we talk about the quote unquote driver shortage narrative. It was meant to change regulations, influence the way people think about getting drivers into the industry, lower the barriers to entry. And the thesis was they would end up at the larger carriers, just like your carrier. The problem was the small guys took advantage.
Yeah.
They took advantage of the deregulation. And I think when there was an effort to lower the barriers to entry, the thought was, hey, these guys will be safe because they'll come work for us and we'll train them, and then they'll end up in our starter fleet, and they'll eventually end up as an owner operator, and that's okay. You're okay. You guys are okay with it as a class. What no one saw coming was what happened, which was the bottom fell out, because now these actors that took advantage of the holes just absolutely ripped it open. And as I learned yesterday, the FMCSA will say there's a due process. Regulatory actions are not quick.
Right.
Regulatory and investigations are not quick. And therefore, there was a lot of folks taking advantage of the system. And I don't think we will ever see a situation where the trucking industry tries to lower the barriers to entry the way it did over the past decade, because you got a safety, security, and economic crisis, and follow the money.
Well, look at
Follow the money. The money cares about having more barriers to entry, not less.
But look at what happened here during COVID. Rates got very high.
Start rates shot up, so did contract.
People that actually ran for carriers would go out and buy a truck and go start hauling. Brokers started coming out of the woodwork with additional freight. And what you saw was this big peak here.
Yep.
And that big peak basically is kind of the inverse of what you saw on the previous chart.
Yep. I mean, just the whole bottom fell out of the market. I just can't imagine.
And a lot of that was somewhat predictable.
Yep.
You know,
Well,
but-
you oversupplied the market.
Yeah.
And you totally can see that in the total number of trucks, total number of operating authorities. We now know, I mean, at one point, Zach, you had a great chart. 28% more trucks were added during the peak, during COVID, than we ended up after the fact. That seems so unbelievable at the time. You call a lot of heat.
Yeah.
And yet you turned out to be right.
Yeah, I was right. It was 1%, 1 to 2% was the argument. We were 1 to 2% oversupplied.
This next one is for Max also. Can Max elaborate more on why utilization is such an important metric? How does it versus rate impact a trucking company's overall profitability and OR?
You know, utilization to me is the number one thing that you got to focus on, because you've got X number of dollars that you pay for that truck, X number of dollars you pay for the driver. So you've got a fixed cost that you've got to cover. So the more miles you can put on that truck, the more profit that you can create. If you look at the long-term goal or long-term cycles, is rate is volatile. It goes up, it goes down. Shippers control it, brokers control it. Everybody else and their cousin is out there controlling rate. At US Express, we'd try to hold our rates, but then you'd find out that everybody else is cutting rates, so you had to follow. You know, we had one carrier. This is I think it's 2008. Actually gave a rate of 85 cents a mile anywhere in the country.
Big old orange trucks. All over the country for 85 cents a mile. You can have as many of those orange trucks as you want.
Which was, to me, one of the dumbest things that you could ever do, because it kind of screwed up the whole market.
Yeah.
I mean, you know,
But they
people.
were, in fairness to the Schneider, they were trying to run their trucks. They were trying to utilize their
They were
trucks.
trying to get
because
the utilization.
The bottom was falling out of the market. It was the biggest financial crisis. Everybody was panicked. And they were simply trying to basically cover the fuel and the driver wages.
But they were focused on utilization. That's what they were trying to get.
They're still around.
And
They're
if
still
you go
there.
back to the old North American van lines theory, you know, y'all are probably too young to know that, but they used to have a deal when they had a truck in your market, then they would quote you a rate, and it'd be cheap enough to move that to the next market that they wanted to go to. You know, so they'd go in and buy the business.
Yeah.
You know, if you're a carrier for that customer, you just basically had to put up with it.
Yeah,
You know,
that's it is such an interesting time. There's so many lessons from this industry that we can learn.
Well, and there's
But
a lot.
utilization is all about revenue per truck per week. That is the metric,
Well,
which is a combination of miles times rate per mile.
Well, and it's really loaded miles.
Loaded miles, good point.
Yeah, I mean, that's the key.
But utilization, keeping those wheels running is so important.
Well, and it's also a big
revenue.
plus for the driver, because, you know, on a pay per mile basis, he's getting higher pay too. So you tend to keep drivers more satisfied when they get more miles.
Makes sense.
And this next one says, what advice would you give to a carrier that has a conditional rating but has made safety improvements and has submitted their case to the FMCSA to get the conditional rating removed, but they're not hearing back from the FMCSA in a timely manner?
Yeah, I think this is an unfortunate situation because I think there are some carriers, we've talked about conditional. It's very easy for us to sit here and talk about blanket things. We do market-driven conversation, but this is impacting lives.
Right.
And there are certainly carriers that are doing everything they can, that care deeply about it, and have gotten caught up in a mistake or a bad rating. This is a really frustrating thing because the regulators just don't have the resources. I asked yesterday, point blank, what do you do if you don't have a safety rating? Should you call the FMCSA and ask for inspection? Might be the first time ever. The FMCSA said, no, we won't do those. We cannot handle the amount of inbound. I think it's a matter of wait and see. I mean, I'd love to ask, that's actually a great question for Derek Mars.
Yeah.
I will ask him that question because I don't know. I don't know the answer. It's never been more important.
One thing that we used to do at U.S. Express, and we had to focus on safety, is we would bring in consultants. Most of them had worked for Federal Motor Care Association before, but they would actually do an audit, like they were coming in to do an audit.
Like a fake audit.
A fake audit,
Yeah.
but they would do an audit and tell us where we were deficient. So we were constantly fixing those. That was an annual event for U.S. Express.
And that way, when the people show up, it's like the old restaurant inspection.
Yeah.
Where the last thing you want to do is have and look, if you eat there, you want them coming in and checking. If you run the restaurant, the last thing you want is to be an off day because that is your rating and you are doomed. There's been many restaurants here in town that get a low safety rating and nobody will eat there for forever. You're like, I'm not going back there.
The ice scoop in the bucket.
But one thing that having those people come in, it not only showed us where we were deficient, but also they developed the reporting. So when the regulators came in, it was easier for them to look and see where the issues were.
So you had all the resources in the world to do that. What do you
Big Carrier
advise?
has that, yes.
What do you advise an owner operator or even a small fleet with 5 trucks? They may not be able to afford a consultant. What should they do, Dad, from your perspective, to really ensure that they can get this conditional rating? Because it could be the kiss of death for them.
Well, they've got to go out and learn about truck safety. And unfortunately, there's no schools that teach you that. Most of us had to learn it the hard way. You read the regulations, and you got to figure out what they really say, and then try to figure out how to apply it in the real world.
You know what I would probably do?
There's a lot of differences there.
You know what I would probably do if I were this fleet? I would go to a couple brokers, because the highest risk transaction is the carrier you don't know, or a broker. I would go to a broker, and maybe I would say, look, I know I have this conditional safety rating. This is the circumstances. I'm going to run. I'd go to someone with large scale that can keep me running. I want to run exclusively for you. And I will provide, this is my deficiency, my hours of service problem, or I had a maintenance problem, or I had a driver problem. I know it's there. I'm going to demonstrate that I am safe. And I'm going to provide the information that you need to underwrite me. And I'm going to stay until I can get this released. I'm going to run freight for you. And look, there's enough big brokers out there that can keep you loaded. You can go C.H. Robinson, TQL, RXO, like JB Hunt. Any of the big players have enough freight across the country that can keep you running. And if that isn't good enough, maybe 1 or 2. You could do the same thing. This is where having important relationships and demonstrating compliance is going to really set you apart from everybody else, because the broker wants to load you.
Right.
They just don't want to load you with a bullet that could be fired back at them.
Well, another resource could go to your insurer, because they have experts too.
That's a great point.
And they can probably do their audit and tell you where you need to really be working.
And then get a letter. Again, right now, this is where this is guilty until proven innocent. Everybody who's here is guilty until proven innocent, and it's an unfortunate reality, because that's what the plaintiff systems have done to our court system. We have too many lawyers, too many billboard lawyers. Morgan & Morgan is out to destroy us all, and they want to get you in court and put you on the stand and prove that you didn't do your job.
Well, in the past, the lawyer had to prove that you did something wrong. Now what the judges are letting them do is go shopping. Okay, if you didn't, you created an accident. Okay, was it?
Well, they didn't create an accident. Had an accident.
Had an accident. Okay, driver did fall asleep. Okay, they had to prove that. They couldn't prove it. The case is over. Now they let them go shopping.
What does that mean, shopping?
That means anything that carrier or that driver could have possibly done wrong, they can go shopping to find that one thing that might be deficient.
We know
is it defective hiring? Or is it the driver was drunk, or was he watching YouTube as he's going down the highway? I mean, there's all kinds of things that these lawyers go shopping.
I don't think, at least according to social media, that a lot of people realize that, because I think a lot of the argument is, I am not doing anything wrong. They have to prove I did something wrong. But what you're describing is very different, which is the judge are letting discovery.
That's right.
They're letting a very open-ended discovery. They're not narrowing it. They're saying you can go find anything.
Well, they aren't letting them prove what they came to court to prove. They're letting them prove that something's wrong somewhere. And it may not have anything to do with that accident, but if they prove something is wrong, then you're guilty.
I know you guys had some big payouts because of that.
Yeah.
I was at the fraud summit yesterday, and one of the conversations, and I don't know that this was clear to me, this idea of partial liability, who's at fault. And we saw it in the Warner case, percentage case. Now here's the crazy thing that I've learned, is that basically if there's a $10 million lawsuit and the carrier only has $750,000 insurance, even if the broker is 5% at fault, they could be stuck with the entire pay amount, not the 5%, which would be $500,000. They could be stuck with the $9 million, because in certain districts, in certain states, if I get a $10 million and there's co-defendants, they can go after the full amount against the party. So if one party defaults in the amount owed, even if they're 90% responsible, it could be the burden of the broker to actually pay it. That to me is a big one. The other statement that was made on the same idea of partial liability is the fact that juries are more likely to be sympathetic to truck drivers in a courtroom because they probably know a truck driver in their community, will have more empathy towards a truck driver than they will a freight broker. And that is something that was really interesting in terms of, now, at the end of the day, you have an accident, you have a claim. But in terms of determining fault percentages, it could go against a broker for no fault of their own other than a jury. And we saw this with the 𝐂𝐫𝐚𝐢𝐠 case. 𝐂𝐭𝐫𝐚 just had a payment, a claim of a jury award of $86 million. And the crazy part was, during the case, John 𝐂𝐫𝐚𝐢𝐠 wrote about this, during the actual trial, the jury determined that the carrier was not at fault, but they didn't want to pin the fault on the truck driver because they felt bad for the truck driver. They had a lot of sympathy. So they came back on a technicality during the award and ended up awarding, basically saying that 𝐂𝐭𝐫𝐚 is at fault, and ended up some weird technicality. It's a very strange lawsuit that I didn't understand, but 𝐂𝐭𝐫𝐚 ended up paying $86 million. They were determined to not be at fault during trial, and this is the stuff that is so unpredictable.
We had a case at U.S. Express where a railroad had actually created a whiteout.
What does that mean?
Smoke, where you can't see, kind of like fog. And there's about 15 cars in the pilot. Well, U.S. Express comes along and we bump the last car. Less than $6,000 worth of damage to the car. Railroad ends up walking away with no liability, but because we were big pockets, we ended up having to pay about $12 million.
This is the risk. I mean, that's the problem. And that's the part that I think, until you've lived it and heard it from the asset carriers that have gotten sued with lots of money, the world's different. And that's the scariest part, is this is so unpredictable. Nobody knows. And I don't care. We can all speculate on what's going to happen, but nobody knows the answer. I don't know the answer. You don't know the answer. You don't know this. We won't find out. The only way we're going to find out is when this stuff gets litigated by plaintiffs' attorneys. Zach, State of Freight, I've enjoyed doing it with you. For those that are interested in this content, we will have State of Freight, but it will be a part of FreightWaves Today, which comes out June 1st.
Right. Last one. Signing off.
Today, special thanks to Zach and Craig and Max for being here this afternoon and sharing your insights with us. As always, we appreciate our audience as well for joining us at all of these events each month and asking such great questions. FreightWaves is bringing you some events over the next couple of months. We have the Domestic Supply Chain Summit, a virtual event coming up on June 17th, as well as the Supply Chain AI Symposium happening in person in Chicago on July 15th. You can register for any of our events at live.freightwaves.com. And like Craig mentioned, beginning June 1st, State of Freight is moving to FreightWaves' new daily show, FreightWaves Today. So be sure to tune in at tv.freightwaves.com/today. Each day at noon Eastern Time for ongoing market analysis, breaking industry news, and expert insights across the freight and supply chain landscape. We look forward to seeing you all there. Thank you, everyone.